So does the rally really need a rate cut? And will we see one as soon as July? Let's bring in Tony Dwyer, Chief Market Strategist at Canaccord Genuity. Tony, great to have you with us.
Great to be here, Mel.
We should tell the audience, remind them that your price target for the end of the year is $29.50.
Yeah,
so we're just about, exactly.
We're just about kind of bearish.
Yeah, for me. You know, a price target on valuation at this point in the year is kind of stupid. So we're focused on our 33.50 target for next year, and I think that might be a little bit too low as well.
What happens between now and the end of next year to give us, 400 points to the upside?
Inflation stays low, the Fed gets easy. Remember our 1995 analog? It's playing out almost exactly from every angle that I can find. It's almost exactly like that environment. So you don't go into a recession. Remember that where I've been different. I agree with most of the bears. Yes, the economy's slowing. It almost looks like it's going to go negative. That's the bull story. That's always been the bull story because it takes it takes rates down, and as long as you know you're not going into recession, that gives you upside in equities. Remember, the average PE multiple when core inflation is between 1% and 3% is 19 times. It was there for most of 16 and 17.
Could we, Tony, almost even have had synthetic recession? And what I mean by that is basically, if you look at the 2-10 spreads and that which we often say have been these points where we've had the inversions, and you follow this for the last 30 years, you actually see that we kind of done exactly what you're supposed to do at a recession, even more than we did in Q1 2016 when everyone thought we were getting there.
Jimmy, I think it's a great point, and this is kind of something I'll posit for everybody. In the 1950s, the market quadrupled, and depending on which index, it quadrupled or quintupled. You had 3 recessions in the 1950s. Inflation was around similar levels to today. Interest rates were around similar levels to today, and you just had very brief recessions. We've had 3 almost recessions this cycle. We had the European debt crisis, which caused a 19.6% drop in the market. I'm sorry, folks, that's 20% to me. We're not. Then we had 2015-16, clearly a global industrial crisis on energy price and commodity collapse. And then we had a 19.8%, again, I will round that up to 20%, in the fourth quarter of last year, and now the slowdown. So we've had almost 3 recession-like scenarios, and the market's traded that way. We're not 10 years into a market cycle. We're 5 or 6 months into a market cycle. We had a 20% drop.
So Tony, if the economy does better, he doesn't cut, and the market rallies. If the economy does worse, he cuts. Is it Goldilocks, the same way that Karen just asked me? Do you see it as Goldilocks? And I know you're a lot more conservative than I, so I'm actually going to follow your opinion.
But, for a guy with Goldilocks.
Right. I don't think there's no world right now, in my world, where the economic data is going to get aggressively better. I mean, the whole bull story is that it gets worse. It's going to get worse from here. What made the Fed go from tightening on February 1st, 95 to cutting in July, just a few months later? A negative payroll report. I'd be blown away if we don't get at some point either a negative revision to the recent one or a negative payroll.
Just to press on Steve's other point, and if the data comes up a little bit better, then does your 33.50 go out the window? Because you had just prefaced this whole thing saying bulls want this softening in the data. That's the playbook.
I don't think it'll get that high, but again, you have to go into a sustained recession. So I think it's really important, Mel, to talk about that for a second. How do you know if you're going into a recession or not? People come on TV all the time and say the Treasury bond market is telling you we're going into a recession. You're at 203 on the 10-year. Well, as Tim pointed out, the rest of credit's ripping. You got high yield debt ripping. You got the LQD, which is investment grade debt, at a high. You know you've got an economic problem when the yield on high yield paper is spiking because nobody wants it and they're selling it. At the same time, Treasury yields are going down. That's what creates the gap. What's happening today is it's widening a little bit because Treasury yields are going down faster than high yields. So there's no areas of credit, mortgage credit, agency credit, corporate credit, that I can find that show we got a problem here and you want to get really scared.
All right, Tony, great to see you as always. Tony
Thank
Dwyer,
you for having me,
Canaccord Genuity. Guy, what do you think?
It's fascinating. The bull case is that things get worse. And Tony's right. I mean, he's exactly right. I mean, think how preposterous that is. I mean, it goes to show you that, to me, everything is predicated on what central banks do, not only here, but globally. There's a madness to that. But then last night I'm flipping around, I'm watching President Trump talk about the greatest economy in the history of our republic. So there's something askew there. I mean, I think I know what it is, but it doesn't really matter. But you can't have, in my opinion, even considering rate cuts in the greatest economy in the history of the United States.